Have you ever committed to finishing a big project in what you thought was probably too short a time and then had to change course and elongate the work? Yeah, well, that's what happened in today's episode. Your host thought we could cover what to expect in 2023 for both the economy and the markets. Fat chance. As a result, you'll have to sit tight for another week to hear our take on the back half of that pairing. But stay tuned as today we delve into what we might expect in the U.S. and global economies in the coming year, right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Eric Olson and Adrian Nicholson. We've got the team together for the new year. Adrian, we missed you. How was your time away? Welcome back.
It was great. I definitely took advantage of my time away. I spent a lot of time with Alex and my dog, spent a lot of time with family and friends, watched a lot of sports and movies. So I definitely was able to recharge and just enjoy myself. So it was a really good time.
Hey, Adrian, did you spending that time up in the blizzard of all blizzards?
So it was actually raining, and it didn't seem like there wasn't actually a lot of snow up in Maine when I first got there, and then the rain pretty much wiped it all away. We did lose power for just a little bit, but luckily it came back on, which is pretty rare where we're at in Maine. So I really couldn't complain too much.
Okay, I guess I was thinking somehow that the snow fall had traveled further east. So, but anyway, that's good that you escaped it. How about you, Roshan?
Yeah, we didn't really have too much snow. We had some cold weather, but then it warmed up to the 60s. So interesting weather change over a week. Eric, how was your holidays?
Well, we had a foot and a half here because of a lot of lake effect snow just east of Lake Michigan. But since then, just like you, full warm up, and now it looks there's almost no snow out there. It's incredible.
All melted.
Hey, well, we got a great topic today.
Yes,
why don't you introduce it?
Well, we're going to talk about the economic and market outlook for 2023. I think this is a very important topic for our listeners, for what to do with your portfolio, how to prepare yourself for this year. I think last year, 2022, caught a lot of us by surprise, just with everything that happened, the magnitude and depth of Fed policy and so on. So I think discussing where things are headed will help prepare you for this year, 2023.
Mm-hmm. Yeah. A year like 2022 with kind of in the recent memory can kind of rattle your cage a little bit with not just the economy sort of going topsy-turvy in some ways, but really having both stocks and bonds in the same year have such rough go of things is undoubtedly unsettling. And I'm sure our listeners are thinking about, okay, what are we in for in 2023? Let's talk about that.
Yeah, and actually, when you talk about last year, I wish I could remember that stat. I think it was the Bank of America that said it was the worst performance in 110 years for stock and bond portfolio. If that's correct, I'd need to go back to that episode and re-listen to it to get the exact on it. But yeah, well, definitely a rough year. And I mean, gentlemen, what are you seeing? What do you think? I think it's going to be better in 2023. Are we on the same page? What are you reading? What are you seeing?
Adrian, what about you?
So let's just start with one of the most talked about topics then in 2022, which was inflation. That's definitely going to be a main driver, something that people are going to be looking at this year just to see where that's headed. And most of the research I'm finding is saying that inflation is starting to head in the right direction, and that is decelerating right now. And there are two main areas that people are looking at to see if this is going to continue. One of the common ones is just the normalization in the supply chain. That's still something that could really just derail the economy if that just decides to not improve and not get better. And one big area that impacts the supply chain right now is definitely China. If their reopening is going to go well, that's going to be a big catalyst on if the supply chain is going to improve. and just also just the energy supply in Europe as well. If there's continued conflict, if the conflict gets worse overseas, that could really just disrupt a lot of things and really ultimately impact the supply chain, which will trickle down and make inflation worse. So that was one of the areas I really wanted to just dive deeper in today and just talk about, because that was just such a important theme that was going on in 2022. Is inflation going to get under control or not? And the supply chain was definitely a big part of that.
It's interesting. A year ago, we were having this conversation, and we were looking out at what inflation expectations were and where they might head. And I will say mea culpa. I was looking at a lot of the consensus forecasts to where inflation would end at the end of 2022. And broadly speaking, they were pointing toward settling in at about a 3.5% underlying inflation rate. And well, of course, we didn't do that at all. And that certainly was a surprise, not only to me, but obviously as well to the Federal Reserve, which then, in the face of continued sustained higher than expected inflation, higher at least than they expected and I expected, then that produced this policy of, okay, we're going to continue to ratchet up these rates, the interest rates, and do so at a more aggressive level. That said, now as I look out, you gentlemen may be seeing something different than I am seeing, but it seems as though, again, the consensus now is that for toward the end of 2023, inflation rates should moderate to something higher than we had been having, higher than the twos or sub twos that we had been having before COVID hit, but not in the sevens or eights, probably something closer to about a 4. Have you been reading anything along those same lines?
I have. I've seen that. I've been looking for just what are more the variant views out there, and the consensus seems to be inflation will not get down to where the Fed wants it to, but will show a trend and get low enough where the Fed will pivot. So last year's market, and I think this year is very much so, will be a Fed driven market. Inflation is going to lead to Fed policy. Fed policy will lead to where the market heads. So so I've seen a couple outlooks where they've said stuff like, well, it's easier to get down from 9 to 5, from the inflation top level, but getting down from a 5 to a 2, it's going to be a lot longer and a lot more persistent. Those are the ones that I'm seeing that are calling for a deeper recession versus a soft landing. But the consensus seems to be, tell me if you've seen the same thing. First half of the year is going to be rough. We're going to have a recession. It'll be mild. There'll be a relatively soft landing. And then second half of the year, the markets will turn, recover the losses from the first half, and end the year positive. And I'm typically seeing stuff in the upper single digit range for what the outlook is for the year end. Are you seeing a similar consensus? Is that the general ballpark where you see most firms are coming out with their outlook?
Well, first of all, I love the concept, and I think this is useful to introduce the concept of a tale of 2 years. 2023 is a tale of two years, possibly, or two halves at least. And incidentally, I think 2022 could be said to be also a tale of two halves. Just looking at the markets, most of the damage in the markets, while we didn't end the year well, most of the damage in the markets had already occurred by mid-year. And so from that point forward, it was choppy, lots of ups, lots of downs, much more volatility than we commonly expect, but not an equivalent decline in the markets as we had seen in the second half as we had seen in the first half. So in looking ahead to 2023, yes, I've seen the same sorts of sets of expectations that at some point things will find a bottom and then will rise. Here, of course, we're talking about markets, not necessarily the economy, which is on a slightly different timetable. So, do you buy that argument, basically, Roshan?
I, I, I hesitate answering that because I buy part of it, but I don't buy. I, I, I felt better about it when it wasn't the consensus.
Mhm.
And that
Okay.
now that it is, it scares me a little. And I say that because this is, if you remember in our episode back in September, that's what I had said back then, right?
Mhm.
I thought that we're going to have a roughly 6 months, which would put us into March, into the second quarter. So I said a rough 6 to 9 months, and then I thought things would stabilize and get better. And now that that is the consensus, it's a little concerning to me because
Mhm.
I guess I felt more comfortable being a little bit out there on my own, especially when you look back at last year's consensus and how wrong that was.
Mhm.
So when I look at the two variant sides tend to be one, it's gonna inflation's gonna persist for longer. It'll be more beyond the second quarter, more like 2023 will be a bad year. Where I've seen some say things like 2023 will be, one of the worst I think in 40 years. I'm going to see if I can find that that firm or that analyst that that
Yeah,
and
and
come
So
back to
the
you
Roshan,
with it.
worst
I'll let you look
from an
that up. There's just one more thing I want to just add on to this conversation, which kind of made 2022 even more interesting with inflation being so high, yet the labor market was just really strong, didn't really seem to be impacted. And that seemed like the thing that was helping us stay out of that recession, where now the consensus is and what people are looking for right now you're starting to see it right now, is job openings and wage growth beginning to slow down. And that's really going to impact the impact of global growth in 2023. So the labor market too is something that's going to be key in this market and economic growth that people are going to be looking at as well, because the labor market was very strong because there's a lot of stimulus and a lot of things out there just trying to keep the labor market and the economy going. And now you're starting to see the effects of that and the aftermath of it, which is going to be really important for investors to really look at.
Adrian, here's what I find so unpersuasive in some ways about this discussion. While on the one hand, I agree with what you've just said, that the direction of change on those things is likely. What it doesn't discuss is the magnitude of those changes. When we talk about inflation, pardon me, when we talk about unemployment rates and a slowing hiring and so forth, I'm old enough to remember instances like 2008 when you had pretty significant layoffs. You had people who lost jobs and were out of work for a sustained period of time. I'm old enough to remember as well when the internet bubble burst and people at during that process, thousands, hundreds of millions were thrown out of work. I'm also unfortunately old enough to remember back to the recession of 1982. Granted, I was a young man, but I nevertheless remember those recessions. So when I think about those sorts of precedents and in my own lifetime for recession, I don't when you're looking at help wanted signs pretty much everywhere for people, and I granted there's layoffs in the tech sector. I think tech had gotten really fat and happy and really grossly bloated and hadn't learned to make do with fewer people, especially when you I don't want to, I'm sure you've heard the stories about sort of meditation rooms and foosball tables and on and on and on. You're thinking, do they get any work done during the course of the day? I don't want to poke too much fun at them, but when you look at other areas of the economy, they're still hiring, and I find that just phenomenal. So if in 2023, yes, we have somewhat slowed hiring, maybe a few more people that are out of work. If we wind up at an unemployment rate, let's say 4.5 to 5, that's not as good as a 3.5, or a 4, but it's nothing like an unemployment rate of an 8 to a 10.
That's a good take there, Eric. And I think also just one concept too that's really big when it comes to just market and economic outlooks is we just don't really know the future. And one of the big catalysts for big market major moves is black swan events, and those by definition are just unpredictable. And those events are what can cause what you just described there, those 8 to 10% of unemployment, those big changes in the economy and the markets, where all we can really do in this discussion is really talk about what happened last year, what are people expecting, what are kind of like the indicators really pointing to right now, and just going for what we have to just really position our ways to profit if we can from these types of situations. But I'm definitely following it. I really appreciate you bringing that up, though, Eric.
Well, I'm looking forward to thank you, Adrian, and I'm looking forward to our discussion a little bit later in this episode about the market implications of all of this. But on the economy, sticking with that subject for just a bit, what other concerns or areas should our listeners be monitoring?
Well, let me jump in real quick. I found that source I'd mentioned. It was Barclays that said the worst economy for 40 years. Now, they didn't say worst stock market. They then followed that up with they recommend bonds over stocks and a healthy allocation to cash. So I'm looking this up as we speak. 40 years brings us to 83, but 83 was a 17% gaining year for the market. So I'm not sure what year they're referring to in there, but that's their 1 point. And I'm going to quote it. We expect advanced economies to slip into a recession, and we forecast global growth at just 1.7%, one of the weakest years for the world economy in 40 years.
That I believe. Now, and which again, if we make the distinction between markets and the economy, we'll come back to markets a little bit later. But if we talk about the economy, a slowdown into the ones or the twos, that doesn't seem implausible to me at all. And that absolutely would be at a global level, certainly, aside from the global financial crisis and aside from the impact of the COVID pandemic. If you treat those as anomalous, or to use your language just a moment ago, Adrian, black swan events, then I would say, yes, leave those two aside. And no question, it does seem to me that we're in line for slower global growth.
Yeah, agreed. And you know what's interesting thing that I just listened to? I was listening to an interview with Bill Nygren, who's a well-known investment manager with Oakmark Capital, and he was saying that uh, most professionals in the field now haven't experienced a typical bear market or recession. Just saying that, and I'm misquoting, it wasn't most, maybe many professionals, but saying that the last two things that we've been hit with, the global pandemic and the Great Recession, those are both more similar to, as Adrian said, black swan events. They aren't a typical, this is a bear market. We've got a bit of a change. Now, thinking longer terms when we go to market outlook and where things are headed, I do think this is the beginning of a different type of cycle that we haven't seen since prior to 08, 09, where I think rates have gone up, and we're not going to have this zero rate policy. And I'm looking back at what's happened historically, and this will, for everyone listening, this isn't only a 2023 thing, this will be beyond. But I'm wondering, are we going to, from an indexing perspective, have another lost decade between 2000 and 2010? If you had put your money just in the indexes, you didn't really make anything, because we had them run up and drop, and then in 09 crash and then recover a little bit by 2010. I'm wondering, now that doesn't mean you can't make money in this. It means that indexing won't be as profitable as they've been in the past. But I'm looking at what's going on right now economically, and I'm wondering if we're setting the stage for something similar from an indexing perspective.
That's an interesting point. So I want to introduce, just as a preface to my response to what you've said, Roshan, the concept for our listeners of something known as talking your book. So Roshan and I tend to be very eclectic, and I may be a little bit more than even Roshan eclectic in views. So just to acknowledge that there's certainly some portions of clients' portfolios which are more buy and hold, and which are more just we're trying to get a hold of the asset class and participate in an asset class rather than necessarily try to beat the asset class. But in Roshan's case, and in my case, there's also things that we do that are actively managed. And so this concept of talking your book, sometimes you'll hear people, forecasting things or talking about the in the future the expected superiority of a certain approach when it conveniently matches up with exactly the way that they want to manage assets, or that they do manage assets. I want to say in our defense, because it could be mistaken for sounding like talking our book. I think what we're booking our talk. It's the opposite. In other words, we manage assets or recommend the management approaches to assets that align with our outlook on these sorts of things. And so for anyone who was thinking, this sounds a little fishy, because we've heard these guys talk in the past about this or that non-index based approach, I want to say that we start with our beliefs, and then our allocations of capital follow. But
let me respond to
Roshan,
that before you continue. I have had and still do have some index-based strategies because in the event that I'm wrong, I don't want to miss the boat.
Okay,
so
all right.
Now, but I have lowered allocation to that as well. So just to defend myself from talking my book, or like that's proof to Eric what you said. I'm booking my talk as opposed to talking my book.
Okay, fantastic. So I do agree that we're in a period where, with the advent of what I think will be, as you just said, higher sustained interest rate policy on the part of the Fed, and then hence as well higher interest rates generally throughout the economy, that a lot of the forces that led to the just incredible appreciation of growth stocks, specifically tech stocks, during the period from 2009 and forward until the end of 2021. If indeed interest rates are higher, I think it won't be as easy for the tech sector and for growth stocks generally to thrive in the same way that they had thrived, to have this vast outperformance against other sorts of approaches. So my expectation is that in a higher interest rate environment, that broadly speaking, we'll see more success found in value-oriented strategies. And indeed, that has been the case since the latter part of 2021. Value strategies as a group are down especially on the large side, are down in the maybe single digits, or down single digits in 2022, or maybe low teens. Whereas the NASDAQ during that same period was down about 30%, in that neighborhood. That's not a precise number. So, especially insofar as the large market capitalization indices are overweighted, if you will, or at least reflecting, they're not overweighted, they're correctly reflecting the weightings that exist on those large tech stocks. Then on that basis, as those retain their still outsized position, if they struggle, then broadly speaking, it stands to reason that index-based strategies also would struggle.
And you look back, I wish I could remember what years these were, but there's so many years in the past decade where if you take out the FANG stocks, back, and they've changed the name with Facebook, but it was, Facebook, Apple, Amazon, Netflix, and Google. There were many years where if you take out those fives, you had either very low or negative performance in the indexes.
Mm-hmm. Yeah, that is really true. So at this point, I think gravitating this isn't going to be a new concept for our listeners. Gravitating to quality, gravitating to value, those strategies are probably going to be favored in a higher interest rate environment, whether it's 2023 or going forward. In fact, both of you have mentioned the relationship between bonds and stocks and how to allocate across those asset classes broadly based on expectations for 2023. I just want to highlight one other aspect of the connection between our thinking about bonds and our thinking about stocks, and that is the concept of duration. So I'm going to introduce this concept here starting with bonds. So we often think about maturities on bonds, as short maturities, like within a year or two or three, long maturities, let's say, 15, 20, 30 years out, and then intermediate maturities, let's say between 5 and 10 years. Generally speaking, the we use in bond world, we use a slightly different concept for this than maturities or maturity dates. We use the concept of duration, and the reason we use the concept of duration is that those those bonds that are paying a lot higher interest, even if they're longer dated, have a shorter duration because you're recapturing some of your money faster. Well, the same principle is true in stocks. If short duration bonds hold up better in periods of rising interest rates, it also stands to reason that stocks with at least a notionally shorter duration, a conceptually shorter duration, that is to say, stocks that are paying out real money now instead of asking you to wait for that real money to show up 10 years down the road when they've grown to a certain size, then shorter duration stocks, all else being equal, that's an important caveat, shorter duration stocks, all else being equal, also would seem to me would follow that same logic and would hold up better in a rising interest rate environment than low dividend stocks. Guys, does that logic hold for you as well?
Well, I think we've seen that this year, right? And duration, it's not exactly the term to define it, but those no earnings growth stocks tend to be what took the biggest hit this year. And it's because now that you've got higher rates, the cost of capital goes up for them, and the time frame to get your money back, the investors want their money back sooner now than they did a year ago. And because you now have better rates. I remember on one of our previous episodes, you used the word Tina, there is no alternative. And well, now there is, right? And so you've got to look at that. I want to take us back to the 2023 outlook because we can go off on this tangent for a long time. Okay. And we started out talking about inflation and rates. I believe that's Adrian, where you started us out, correct?
Yes.
Yeah, and is there what's next on your list? So inflation's going to drive Fed policy, which will drive rates. Adrian, what else do you have on your list?
Well, just one more thing I wanted to touch on as far as the rates conversation goes in 2023 is whether or not you see a Fed pivot. And what I'm seeing out there is that it's unlikely that the Fed will make this type of move. I mean, they can do it, but it looks like they'll keep these rates at this level, and that really will impact that conversation we just had on bonds and stocks as well. So that's also something I just wanted to touch on.
So the Fed pivot, meaning the Fed will shift their policy and stop raising rates, and some are also saying there'll potentially be rate cuts coming up. So you're seeing and Adrian, tell me what you're reading, seeing, and expecting is that pivot to happen at some point in 2023. Is that correct?
What I'm seeing is another increase of 125 basis points. That their target is going to be around the 5 to 5.25%, and then they're unlikely to pivot this year.
Interesting.
By the way, for our listeners, basis points, a term that's a term of art within our business, means hundredths of a percentage point. So when Adrian says 125 basis points, what that means is another 1.25% increase in interest rates to the 5 to 5.25% interest rate mark.
Mm-hmm. And then we spoke about this on an earlier podcast as well, and we still want to have like a further discussion on this, that a Fed pivot necessarily isn't good for the overall market. So I just found this an interesting piece just to discuss and look further to this year as well to see how this will impact the overall market.
I'm going to question that. I think a Fed pivot probably is good for markets. It just doesn't take effect immediately.
And I will add on to that and say, I think this time is going to be different when they pivot. So, and Adrian had that data point, which was every time the Feds had that pivot, there's been an average of an 18% decline. Did I get that right, Adrian?
Yes, I think it's around 20%.
20% decline. And why I think that'll be different is because if you break down that data, every other time the Fed has done a pivot, there's been something going on where they've needed to ease policy to help support the economy. Well, this time they're the cause. Not necessarily the inflation, but they're the cause this time.
Yeah.
So I actually think when there is a pivot, I think that 20% decline will not happen. I actually think prior to the pivot, we'll see a speculative uptick in the market where people are saying, "Okay, this is the time they're going to do it," and then when they do, I think we're off to the races. Why I asked you if you're seeing a lot of it for this year, or the expectation of a uh, Fed pivot this year, is because that really was the consensus before. A lot of what I've seen is now Fed pivot fourth quarter or probably next year. Whereas I remember a lot of the talk last year, especially at the beginning of 2022 or first half, was that we'll see that pivot. We'll see that pivot in 2023. Now I think that consensus has been pushed back to later. 2020. Either at earliest, I'm seeing a lot of these firms say are late in 2023, and or more likely in 2024.
Well, so in terms of what we think will happen and what we want to have happen, I wish there was a correspondence between them. I in this case, I pray that the Fed does not pivot. I pray that the Federal Reserve gets out of the business of trying to set interest rates all the time. I would love to see the Federal Reserve allow markets, supply and demand, is just in the same way that supply and demand works for goods and services, it also ought to work for money. And what a borrower and a lender think makes sense for them based on their own outlooks, to me seems that should be what drives all of this. I believe it's in fact the good intentions of the Fed to intervene in this arena that has led actually to so much of the bubble aspects of our economy. I'm not saying that during periods of dire uh, uncertainty, like we had when the global financial crisis hit, I'm not saying the Fed should just sit on the sidelines there. I think it was absolutely useful that they came in and became essentially the liquidity provider of last resort. But this constant need on their part to be tinkering with interest rates seems to me to be so wrongheaded. So, having said that, what I wish for and what they'll do, I have no expectation that they'll do what I want them to do.
Isn't the well, two questions. When was it set by markets last? Do you have any idea? I don't.
Well, I would say you
versus the
had
Fed.
a much less activist approach to interest rate manipulation, and certainly not, I would say, this intense desire to suppress interest rates down to the zero level and hold them there for an indefinite period, like you had in subsequent to the global financial crisis. You didn't have that prior to the global financial crisis, and you certainly didn't have that for the latter part or most of the 20th century. So it's a much newer
Zeros.
phenomenon to have subsequent to the global financial crisis. This intense, um, I would say, godlike belief that they need to have their hands in everything.
See, I think that they got to zero, and the Fed knew they needed to at some point get out of it, but they didn't know how.
Mm-hmm.
And then inflation forced their hand because rates
Mm-hmm.
were starting to go up. I think
Mm-hmm.
in 2015 they started to raise rates, and if I remember correctly, China had their real estate crisis. So then globally, rates did just stopped raising rates in general, and then they did raise rates a little bit, and then we had the global pandemic, and then rates went to zero. So I think that yes, I do agree with you that zero rates forever are not a good thing, and that is that. But I think this the role of the Fed and the complaint against them and the in general, even the European Central Bank, Japan, Britain, is that they're trying to say they're following these Keynesian economic theories. They call it Abenomics over Japan, but where they adjust the rates down to stimulate and adjust them up to contract, and they just never do the up part, at least not as aggressively as they do the down part, right? So I think right now the Fed's got a very good reason with inflation to push it up. And fortunately for Fed policy, employment's been strong, so they can keep down that path, because no matter what anyone says, I think there is political influence there. And if you start seeing a weakening economy, I think Powell will start thinking about his own job and need to do what's needed for the position, whether you like it or not. I just think that's how it works. So, but I agree with you that zero rates are something that we shouldn't have as a policy. I just think where I disagree is I think they've always manipulated the markets, and it's just been more extreme recently.
Well, now you have
versus it being anything.
Now you have me wanting to go, which I hardly have the time for it, but nevertheless, it does sound interesting to go find a good history of the Federal Reserve and in Federal Reserve policy. Anyway, so we've covered rates, we've covered inflation, and I'm thinking, gentlemen, that maybe it makes sense to divide this episode into two parts, and to say today, for the most part, is a conversation about the economy, and then have an episode next week, which is mostly then our outlook for the markets. Your thoughts?
I think this is the rare time I like having a series, Eric.
Yep, I'm down as well. Let's do it.
All right. So with then that being said, so our listeners aren't going, is this going to be a 2-hour episode? No, dear listener, we've just now made an executive decision to go ahead and spare you that. But I do think it is important to just return to one other element of this entire story, which is you highlighted the global outlook for the economy. And I think it's sometimes easy for us in the U.S., insofar as our economy is such a dominant part of the global economy, to grow a little bit inattentive to what's taking place abroad. But just in terms of a quick survey of some things, there's a lot changing around us. So obviously the war in Europe, we've talked about that. There's also China's up and down approach to how it's going to deal with COVID, the relaxation of the zero COVID policy. By the way, gentlemen, I don't pretend to be monitoring on a day-by-day basis exactly where they're going with that. But insofar as now there's been that relaxation, I do think that is probably likely to help with the previously mentioned supply imbalances in the global economy. And you said that, Adrian, was what impact that could have. It seems like there's only up from here. It's hard for me to envision China going back into a total lockdown again. It could happen, but it's hard for me to envision that happening. That said, I also wonder if there's a certain part of the global economy that says we don't now necessarily believe it's prudent to have this unexamined expectation that China will always be our place to outsource manufacturing at a low cost. And what I think you're seeing is there is a decision in many places to say we need to diversify our base of manufacturing operations so that it's all not just concentrated in China. That otherwise we're extremely vulnerable to China domestic policy when that's we've got a global consumer base to supply to. Have you thought about that?
Yeah, well, I mean, you saw that on a specific company basis happen with. I know you were talking about more global economy, but you're seeing it starting with Apple moving. Apple's facility, the Foxconn, moving out of China because they need someplace else where they can manufacture iPhones, right? So I think yes, that's going to happen, and you're seeing the early stages of it. And I think China's response in the fourth quarter to try to ease their zero COVID policy is a response to that.
Yeah, I think there's also, since we're talking about China and its effects on decisions as to where to locate manufacturing operations, it's not just their domestic policy, but it's also their foreign policy. So they have been increasingly bellicose toward Taiwan, and what that has now you're seeing is one of the largest chip manufacturer in the world, if I'm not mistaken, Taiwan Semiconductor Manufacturing Company is saying, okay, if you're making all these threatening noises toward us, then it's not prudent for us to have our operations so concentrated in Taiwan. And so now they're opening factories in other parts of the world and making significant investments there. We have been monitoring for other reasons something taking place in the greater Phoenix area, and Taiwan Semiconductor Manufacturing was announcing originally that they were going to have up on the north side of that metropolitan area a $13 billion plant investment that quickly scaled up into the mid 20s. And now, if I'm not mistaken, is at a $40 billion plant investment. Wow. If you see that sort of impact, and I don't mean just with Taiwan Semiconductor, but just all the effects when China adopts a policy in this way or that way, it certainly has ramifications. And certainly in this case, I think the impact for the United States, at least in that, is a more reliable, potentially more reliable source of semiconductors. B, the creation of jobs in the tech sector, in the manufacturing sector, as opposed to the writing code.
I think that they put the world in a position where they have no choice but to respond like
Mm-hmm.
this, right? You can't, when you go back to the beginning of the inflation issues and the fact that the talk, it's transitory, this is all supply chain issues and so on. A big part of the supply, yes, it was COVID, but it's China,
Mm-hmm.
right?
Mm-hmm.
The big part of the supply chain issues. So I think that's a good thing, to diversify into different parts of the
Mm-hmm.
world.
Yeah. Well,
What else would you add on from an overall global economic policy that is worth
yeah. Well, I
discussing?
do think I don't know exactly what the outcome of the Russian invasion of Ukraine will be, but it doesn't look like it's been anything matching what Russia had originally expected. So now, I guess one question I have is this: does this drag on forever? Does this drag on to a point where there's this? It becomes this. It, increasingly, do they ratchet it up? Do they ratchet it down? Do they hold it in stasis? I don't know exactly what impact will that have, continue to have on energy markets, and for that matter, on fertilizer markets. I'm not sure about that. If I had to make a call, or if I had to make a forecast, I think that Putin's health is an issue, and there's talk about possibly he has a terminal illness. And then the question would be, what are the machinations behind him in terms of the people that would be his successors? My understanding is, at least at a superficial level, most of the people who he has left to remain in the most prominent positions of power are at least as hardline as he is. So that has consequences not only for broad global domestic relations on the part of Russia toward the rest of the world, but then also, I guess, with respect to the war. So I wouldn't be surprised to see on that basis that this war would be a much longer affair than we've probably been expecting.
Yeah, I think when Russia expected it to end in days or
Mm-hmm.
weeks, and as you see, it's just extended. Recently, um, we, the United States, have passed 40 billion in aid to the
Mm-hmm.
Ukraine, and it said as of November, Russia had spent 82 billion in total on the war. Their annual defense budget for 2023 is in that similar
Mm-hmm.
neighborhood. So that's just from us, the United States. They've got 40 billion. I'm sure they've got their money they're getting from other sources to help them, but Ukraine's going to have a similar defense budget as Russia does. So just thinking that is another reason to think this will continue for the long term. I mean, do you see Russia? Do you see either side backing down?
I don't during during Putin's lifetime. I just don't think.
Yeah.
I don't think he can afford to. If he backs down, even if a terminal illness doesn't take him out, his erstwhile backers may.
Well, and I've seen this whole year or so about his health, and I can't say I follow that story too closely, but when I do see it, I wonder if that's propaganda or is that
Mm-hmm.
actually real information we're getting.
That's a good point. I don't know.
Yeah, I'm not sure either. So we've talked about recession risk, inflation, Fed policy, interest rates, war. Uh, we talked about unemployment a little bit, the fact that it stayed strong and it'll continue. Are there any other major themes that you see from an economic perspective that we need to discuss on this episode before we go into the markets next week?
Well, the answer is hundreds or none. So I mean, there's a lot of other areas in which we could talk about it. I think housing and real estate and what's taking place in those as well. But for now, I think we've identified at least some of the major influences that shape our thinking about markets.
Yeah, I agree. We've covered that. So thank you for joining us, everybody. We will be back next week with part 2, where we'll talk about market outlook and some opportunities for you. But this will be a good backdrop and give you an idea of some areas to look to yourself. Please like, subscribe, give us 5 stars, tell your friends and family, and thank you for listening. This has been the Retirement Lifestyle Show.